Hi again. In this episode, we're going to talk about how to protect income from taxes. You're going to be blown away when I share with you that in the United States since 1986, there's only 3 types of income we pay income tax on. So it's rather simple. I'm going to teach you how to get most of your income, especially during retirement, out of those 3 categories and over into a tax-free category in the Internal Revenue Code. So I'm Doug Andrew. I've been a financial strategist and tax minimization specialist for more than 45 years. And if you haven't figured this out yet, Uncle Sam wants some of your money when you earn it, when you save it, when you invest it, when you spend it, and when you die. So I know how you feel when you go out and you work really, really hard and you think you're going to get a paycheck for $5,000 or $10,000. And of course, the first job you probably had, I looked at it and I said, well, wait a minute. Because of all of the taxes, federal and state income tax, the FICA, that's Social Security and Medicare, and I'm getting this net little amount that I can buy gas and groceries or prescriptions or golf green fees. And so I want you to understand some powerful concepts that many people just flat out don't understand. It's a little bit more simple than people really think. I've often asked, is postponing tax a good idea? Many times we look at our savings that we sock away in traditional accounts like IRAs or 401ks, and we envision it like this sumptuous Subway hoagie sandwich depicted here on the left. Well, when you go to retire, this is what it looks like, because Uncle Sam comes in and takes a major bite out of that hard-earned money you've been setting aside. And people sometimes are shocked because they don't realize they're not in a lower tax bracket when they retire. There are 3 types of income subject to income tax. And this has been true since 1986. This was President Ronald Reagan's second term, the 1986 Tax Reform Act. And what he was trying to do is simplify taxes for Americans. And from that point forward until today, there's only 3 types of income that we pay income tax on. This is on the front page of your 1040 tax return. Earned income, passive income, and portfolio income. Now, earned income would be like salaries and wages. Passive income would be maybe rental income or lease income if you had equipment or a piece of real estate or an apartment or a rental house. Portfolio income comes from interest and dividends on your investments. So how do we transfer a lot of our income, especially at the crucial time in life during retirement when we can afford to pay taxes the least, but most Americans get duped into deferring, and now they're paying as much or more in tax. So what I've done for more than 45 years is help people transfer the strategies on their money so that more and more of their income is not one of these 3 categories. It's tax-free. So I'm going to talk about how to do that. So I've found it rather rewarding and interesting that when people would come to me with their yet-to-be taxed IRAs and 401ks, I would go, man, whose retirement were you planning anyway, yours or Uncle Sam's? They thought they were going to be in a lower tax bracket, because that's what we're told, right? Oh, you're just going to be in a lower bracket when you retire, so defer, and then pull out the money later when you'll be in a lower bracket. Well, that has not been true or axiomatic, in other words, just automatic, for more than 25 years. But it took the financial services industry until about 5 or 6 years ago to finally admit, maybe that wasn't the right advice. Maybe we really weren't being good fiduciaries. We could see that if you have any type of a respectable retirement nest egg, people aren't in lower brackets. If you're in a lower bracket, it means you didn't save very much. You don't want to be in a lower tax bracket because you don't have that much money. And so what I want to share with you is that when we go to retire, there are usually 4 different income sources or buckets that we draw from. Some people draw evenly from them, others more from one category or another. But the key that I have found is to transfer as much as you can into what I call the tax-free bucket. So let me explain what I mean. So the four retirement accumulation and income buckets that I referred to are, number one, what we would think of as maybe the investment bucket. This is where most people have probably 80 or 90% of their retirement resources in this country, America, when they retire. It is in yet to be taxed. IRAs or 401ks, and many times that money is in the market. You do not want your retirement nest egg in the market when you retire. See, at retirement planning is very crucial, and it's different than what you maybe did for retirement planning. So I found that many people were way too top heavy with money in this bucket. Now, some people think real estate is the cat's meow. Maybe you just own your home. Many people have a rental property or a duplex or whatever, and they think that by having this paid off piece of property, that's going to give them cash flow. But then when they retire, they're sort of tired of fixing toilets, evicting tenants, and taking out the trash. So they don't want this management-intensive property, but they've painted themselves into this tax trap because they don't want to pay the long-term capital gain. But that can provide income, but I would recommend no more than 30% of your retirement income come from that bucket. And frankly, no more than about 30% should come from this bucket. But most people have most of their money in this one. Now, this one is called the guaranteed bucket. It could be your Social Security income. It could be a pension if you're a school teacher or a police officer. But there are only a handful of annuities that I would recommend that would fit the bill of giving you a guaranteed income. So maybe between 0 up to 80% of your income could come from here, depending upon how much you want to be guaranteed, because there are some good annuities, just a handful, that if you run out of money at age 80 or 85, you won't run out of income if you live to be 120. How would that be, okay? My favorite one is the tax-free bucket. There are some categories where maybe Roth IRAs would be tax-free during retirement, or you might have municipal bonds. I do not put my serious cash in those two. I put mine in what I call the laser fund. It's a max-funded tax advantage insurance contract because I've averaged 8.2% over the last 45 years. The last 25 years, I've averaged 10.07%, and that's a tax-free rate of return. So that's my favorite vehicle. And many times what we do is we help people transfer a lot of money out of this one and get the taxes over and done with and reposition it into this one so it's tax-free from now on. I've written lots of books and educational materials that talk about this, and I teach CPAs and tax attorneys about Section 72E of the Internal Revenue Code, 7702, and 101A. In a nutshell, this is where your money, in what I call the laser fund, can accumulate your money tax-free, allow you to access it throughout retirement for 40 years if you live to be 120, totally tax-free. And when you die, it transfers tax-free. Not only does it transfer, but it increases in value, sometimes doubles or triples. Nothing else in the Internal Revenue Code does that. And these three tax citations have to be complied with. So I'm going to share with you how you can learn more about how you can transfer your money and protect it from taxes, because that's what erodes away most of people's purchasing power, at least a third of most people's retirement income. So let me reiterate that I know how you feel, and sometimes people get extremely frustrated, but there are solutions. Oftentimes I talk about Mr. Taxed to the Max versus Mrs. I Have a Lot More. And in many of my episodes, I actually show you examples of how Mr. Tax to the Max continues to leave his money in IRAs and 401ks, thinking he's saving tax by stringing it out. I can prove to you that you'll pay double or triple the taxes if you take RMDs, required minimum distributions. You string it out. It's called a stretch IRA. That's not the smartest thing to do. You'll end up paying way more in tax. Mrs. I Have a Lot More, she learned how to reposition the money. At least 50 to 60% of her income comes from the tax-free bucket. Do you know we've helped many people go from the highest tax bracket in 5 years to a 0% tax bracket the rest of their life? Look at some of the other episodes, but I want you to understand that this is what has motivated me to be an author, and I've written 11 books thus far, and my most recent one is called The Laser Fund, and I wrote this book to help people like you understand how to avoid unnecessary tax, or if you've painted yourself into a tax trap, how to get out of it and transfer as much into that tax-free bucket. The Laser Fund is actually 2 books in one. See, there's 2 of them here. This one is comprised of 14 chapters with all kinds of charts and graphs and explanations. But if you're more of a right brain person and you like the stories, you flip the book over this direction and you read it about 100 pages comprised of 12 chapters with 62 actual client stories. Sort of like a chicken soup for the financial soul book. And if you want to use your whole brain, you can read both. So what I've done is provided an opportunity for you to be able to receive a copy of this for free if you would like. You just have to go to laserfund.com, L-A-S-E-R fund, F-U-N-D.com, and you pay a nominal $5.95 shipping and handling, and we will fire out a copy of the Laser Fund for you. And if you even want to go into a deep dive, you can take a master class that we recorded, which is over 18 hours of education to your brighter future.